In this video, we're going to discuss a financing lease from the leasee's perspective. Assume that on December 31st, 2019, Waste Management signs an 8-year non-cancelable lease agreement. Notice non-cancelable. It is important for a lease to be non-cancelable for it to be qualified or classified as a financing type lease. And the lease is to build a building from the Rise Warehouse Company. The following information pertains to this lease. The agreement requires equal rental payments of $62,755 beginning on December 31, 2019. The fair value of the building on December 31st, 2019 is $425,000. The building has an estimated economic life of 10 years and a guaranteed residual of 8 years of $19,000 and an expected residual of $13,500. Recall, the excess of any guaranteed residual over the expected residual, in this case, $5,500, will be included in our estimated lease liability. Waste Management depreciates similar buildings using the straight line method. The lease is non-renewable, and at the termination of the lease, the building reverts to the lessor. So notice there's no transfer of ownership as part of this lease. Waste Management's incremental borrowing cost is 6% per year. The lessor's implicit rate is not known. We typically use the lessor's implicit rate unless it's not known. And if it's not known, then we go with the incremental borrower rate of Waste Management or the leasee. So, why is this a financing lease? We've already discussed some of the reasons why it might be one. First, the lease was non-cancelable, and that's a requirement for all financing leases. If you recall, our criteria, there's no transfer of ownership. If there is transfer of ownership, it would be a financing lease. In this case, no transfer of ownership. There's no purchase option mentioned, and that's one of the requirements. But the lease term. We have an 8-year non-cancelable lease, which is 80% of the economic life of the asset. So we fail the lease term test, or we could say we pass it, and hence it's a financing lease. From the present value test, let's go ahead and take a look at that one. We are told we have 8 payments of $62,755. At the end, we also have a guaranteed residual in excess of our expected residual of $5,500. So we find the present value of these cash flows. It's an 8-year term, a 6% interest rate. The payment is $62,755 every year for 8 years. And then we have the $5,500 future value, which again is the excess of our guaranteed residual over the expected residual. And this is an annuity due. If you're making the calculations using your calculator, we get a present value of $416,528, which is more than 90% of the estimated fair value of the building. So this is a financing lease for 2 reasons. We exceed 75% or more of the estimated economic life, and the present value of minimum lease payments exceeds 90% of the fair value of the property. And Waste Management will record this as a financing lease. We mentioned earlier how the guaranteed residual affects the recorded lease liability. If the guaranteed residual is greater than our estimated residual, we include the difference, which in this case was $5,500, in the estimated lease liability. Let's go ahead now and look at transactions and recording transactions under this lease agreement. At the inception of the lease, we will record a rights of use asset equal to the present value of future cash flows, which we figured out was $416,528, and we'll record a lease liability in the same amount. Upon the signing of the lease, we were also making a first or initial lease payment, and we will debit the lease liability and credit cash. We make that same entry every time we make a payment on the lease. So again, 12/31/2020, the next year, we're making that same entry, a credit to cash and a reduction in our lease liability. And we can see those payments on our lease amortization schedule. Of course, when we're making that initial payment at time 0, we've incurred no interest cost. So the entire $62,755 will go towards reducing the lease liability, which will then be $355,773. At the end of the year, then, the interest on our lease liability will be $21,226. That's the lease balance of $353,000 times the 6% interest rate. And we record interest expense, and we record an increase in the lease liability. The lease liability, again, will be reduced every time we make a lease payment. Also, at the end of the first year, we're going to record amortization expense. Our amortization expense, well, let's finish off our lease table. Our amortization expense will be the rights of use asset spread over an 8-year life. So $416,528 divided by 8 years gives us $52,066 every year. We don't credit an accumulated amortization account. We directly reduce the rights of use asset. So again, our interest expense is coming directly from our amortization table. And notice that's simply the 6% interest rate multiplied by our initial lease liability minus the portion that had been applied to principal so far in our first lease payment. Let's look at the entries we're going to make at the end of the second year of owning this asset on 12/31/2021. Again, we're going to record interest expense. Again, coming from our amortization table, it's the $18,735, and we record a reduction in our lease liability. Once again, we record amortization expense as well as a reduction in the rights of use asset. Then, of course, we'll record one more lease payment, the $62,755, reduces our lease liability, and we have a credit to cash. Let's consider two final questions. Suppose that in addition to the $62,755 annual rent payments, Waste Management is also required $8,000 a year for insurance cost for the building directly to the lessor, which was Rise Warehouse Company. How would this, what's referred to as an executory cost, affect the initial measurement of the lease liability and the rights of use asset? Notice our cash flows on this lease have changed. Instead of being $62,775 for 8 years, it's now $70,755 for 8 periods. That will increase the present value of our expected future minimum cash flows to $469,187. And we can see that in our amortization table. Also, now suppose at the end of the lease term, Waste Management and Rise agree that the fair value of the asset is only $19,000. Recall, we expected to make a final cash payment to Rise for $5,500 to make up for the difference in our estimated residual and our guaranteed residual. The guaranteed residual at the end of the 8-year period was $19,000, and we had an expected residual of $13,500. We included that in our present value of our future lease payments, and we incorporated that into both our rights of use asset and our liability. The rights of use asset has been fully amortized at $52,066 a year, every year for 8 years. We had anticipated recording one more payment on this lease in the amount of $5,500. We no longer have to make that payment, but we want to take the liability off our books, and we will record a gain of $5,500.